I'm going to welcome our first speaker up, ladies and gentlemen. It's Jack Watts, and he certainly needs no introduction.
Well, good morning, ladies and gentlemen. Welcome to this year's Grain Market Outlook Conference. As always, it's a pleasure to address you with our analysis at neck break speed. We've got a lot of information, as you've become to expect over the course of the morning. The slides are in your packs, and I think for me, I'm here merely to deliver the analysis that's been done by a lot of the team in the Market Intelligence division of HDB, a very skillful up-and-coming team that we have. Some of them are here today, so please take your time to do that. We're taking a sort of a short-term perspective, what the things being this season, but then sort of dropping in some longer-term drivers. And I think it's important that we try and maintain a little bit of a longer-term focus, although there's a lot of uncertainty ahead of us. Just to take you in terms of structure, we'll set the scene. We'll get you a bit of a warm-up before we hit the ground running and sprint through some global commodity outlooks for wheat, maize and barley, and then really bring that back to, well, what does that mean to the UK situation in 16, 17, indeed beyond, and leave you with some conclusions to go home with. The packs are there. There have been some updates to the slides just because, unfortunately, the markets, particularly the currency markets, don't stay still for submission of presentations, so there's a few updates there that you'll see. But in terms of setting the scene, I think really to elaborate a little bit on what the chairman has touched on already is that we find ourselves in a fairly unique global situation now, in the 4 years of consecutive global grain surplus. Standing here last year, we thought that 3 years was quite unusual, but 4 years, I would say, is fairly unprecedented. The long-term challenges remain. Global demand continues to grow. It's steady, relatively predictable rate. Will continue to be subject to population growth and wealth and trade, of course. And it's not to say that over the last 2 years there's been a clear margin of supply over demand. It remains very finely balanced, and there's a lot of uncertainty sort of long term, not least from the weather, that of course gives us that air of uncertainty and the risk of volatility into markets. I wanted to put this into perspective, really, to kind of to frame the outlook in terms of what we're seeing on the ground at both the farm level and, of course, through the supply chain. And I wanted to start with this chart. This chart really is looking at gross crop revenue, an index of gross crop revenue weighted by the crop areas of the UK. The blue bars look at this from the perspective of a farmer who takes the view of forward selling ahead of harvest, as well as across the marketing year. The line there for a farmer, taking more of a post-harvest view on crop marketing. And the trend to me illustrates, regardless of the market approach, we've seen a continual decline in gross crop revenues over the last few years. In 14 and 15, it was about low prices, but that was offset by relatively good crop yields in the UK, so cushioning some of the blow that low prices could have delivered. In 16, the reverse is quite true. Although we're seeing some higher prices in the post-harvest period, the lower crop yields, or more closer to average crop yields, essentially has been the big blow. And so that's really tightening up prospects as we look at things. That's not to say that costs have moved as well, particularly the commodity input costs. Looking at that volatile line there represents the fertiliser and soil improvers index from the DEFRA data, and that's moved in line largely with grain markets. Caveat to that longer term, though, of course, is what we're seeing with currency, and currency will serve to support or increase potential some of those commodity input prices. The key thing to bear in mind, though, is that prices such as fertiliser aren't necessarily indicative of the full cost base, and what we're seeing is a greater influence coming through from more of those fixed costs at the machinery level, sort of ever appreciating as that bottom line illustrates. So really illustrating that times are tough really at the farm level, and some of the margins are becoming quite challenging. Let's focus about this from the other end of the supply chain and consider this from a procurement, a processing point of view. And the chart here is looking at the annual inflation in feed and milling wheat prices. And largely over the last 3 years, we've seen a continual period of deflation, which has come hand in hand with quite a fierce retail environment. Now we start to see, largely currency-based, we we start to see these increases in price coming through, the re-emergence of inflation in these raw material products. And that's going to coincide with ongoing retail competition, and it's going to give us an interesting mix of drivers in the things. We can't really talk about the outlook without talking about currency, and I really wanted to put the currency situation in context from an agricultural commodities point of view. The chart here is looking at key currencies for key global exporters around the world, really over the last 3 years, against the US dollar being the currency of global trade. And we can bring into this the UK now, and we can start to see at the right-hand side the impact of the post-referendum vote, and of course more recently what's been dubbed the flash crash of late Thursday into Friday morning, really taking sterling into a really unknown territory. So it's true when people say that yes, sterling is the worst performing currency against the dollar in 2016, but from a commodities point of view, I think we need to take a broader look, consider what's happened in the last 3 years, and we see what's happened to the Brazilian real, the peso, and indeed the ruble. It's quite fashionable to be weak against the dollar right now from a global point of view, so it doesn't necessarily set the UK apart. It does help, of course, with export competitiveness. So now that you're all suitably warmed up, I think it's time to head in to think about where we're going from the global commodities perspective. We start by looking at wheat, and really the chart here is just designed to really get your customers where we are in terms of the global dynamic. The box at the bottom of the page there really looks at the growth in global demand on an annual basis, but then on an average of the last 3 years, you can continue to see that gentle growth in demand as we're so much used to. Around the world then we can see various trends in annual production growth for the key producers and exporters of the world. And it's very clear to see that the production base is been more than capable in the medium term of keeping up with demand, particularly the key exporters. At a global level, we're anticipating that 16-17 will produce a yield of around 3.35 tonnes per hectare, and that's up around 2% on the previous record that we saw back in 14-15. From a wheat perspective, that's been quite an interesting dynamic because it's kind of bringing the context of protein dilution amongst yield, and it's sort of creating some issues in the top end of the market. Something that we're quite used to seeing in the UK wheat market, given the scale of our yield, something that I think is probably less familiar on the global stage. I think the market's going to have to sort of try and get its head around. And a lot of the growth heads really coming from those key exporters. We're going to get into the detail of the EU, of course, and a bit on Russia as well. But in terms of around the houses, I think we've got an interesting time coming up out of the Southern Hemisphere. Strong production expected to come out of Australia near to record yields, the current expectation, given the good growing conditions we've seen. A long way to go, and that's, of course, before we start to examine what Australian wheat quality looks like. Argentina coming through a bit of a renaissance in its production. New government came in 12 months ago, and that's really been a big support to agricultural production on top of the weakening of the peso that we saw in the previous chart. So I expect big things that will come from the Southern Hemisphere for those two exporters. Just a quick comment on India. It becomes quite a topical area. We touched on the relevance of India last year. It's sort of operating in the background in the wheat market, certainly recovering year on year, but yields continue to lag, and so we expect to see wheat imports into India, particularly from Australia, and those total imports around 2 million tonnes up, that really at its highest level for a decade, further stock degradation. And India is able to really operate under the radar due to really that global availability of wheat and relatively low prices. Quite topical, unlikely that the season is going to have a fundamental impact upon the market. So with really the influence of that strong supply, strong export availability, the impact on price has been quite marked. And we can see that in the prices. So and sorry for the number of prices on this chart, but it goes to illustrate just how complex the marketplace is from an export point of view. You can see how everything is consolidated all together. And it becomes really, the market is much more about export competitiveness now, given the relatively low global freight rates that we see around the world, which simply has made the world a much smaller place. There's much more about the competitiveness of the export price as much as actually getting the cost of shipping to the particular destination. And what we can start to see is wheat prices around the world have had to start to interact more with maize. In this broken line here, really the global market trying to steal more feed demand away from maize. And that's going to be quite a hotly contested environment because we see surpluses in that maize environment in parts as well. Just interesting, we're looking at all the global export prices. I just wanted to drop into the mix here the UK wheat futures price, not necessarily directly comparable, but it's all in a relationship. And a weak sterling we'd expect to see making UK wheat cheaper in dollar terms. What we're actually starting to see is UK wheat prices actually starting to gradually rise through the ranks, basically because the look and feel of the UK wheat supply and demand is changing this season and will look quite different this season as it has done compared to, say, the last two seasons. We'll get into more detail on that shortly. So big production, and big competition for exports generally means an appreciation in stocks. I think we just need to take stock on stocks, if you will, and understand what it all means and give it some perspective. So the chart here is looking at the global stocks-to-use ratio. We have to be quite careful when we're looking at headline wheat stocks because, of course, we know that all of those stocks aren't necessarily readily available to the market should the market need them. So in that context, we look at the global or the major exporter stocks-to-use ratio, and you can start to see that similar trend, that appreciation in stocks held by the major exporters, which on the whole are relatively mobile stocks and can sort of come to the rescue as and when needed. Just out of interest, the next step is to think about transparency in the global stocks, and this is where we sort of bring a relatively new calculation in, looking at global stock levels, global stocks-to-use ratios, less the influence of China. China represents quite a transparency issue for global wheat stocks, holding a significant proportion. Not an issue this year, given the sheer amount of stock held by the main exporters, availability by the main exporters, but certainly there's a distorting Chinese impact on global stock trends, and one to give us a little bit of concern into the medium to long term on just on the transparency of the global wheat market. So one just to be aware of and we'll continue to follow. On the theme of transparency, I'd like really to sort of to get a little bit nostalgic about the early 70s. Not that I was around then, I'm sure a fair few of you probably were, but to sort of talk about that, and not nostalgic from a Brexit point of view about the early 1970s or so. I dare say there's probably a bit of that floating around as well, but really to think about some of the defining moments we've seen in 40 years ago, essentially, in the global marketplace, and we sort of use the analogy of the Great Grain Robbery, if you will, back in 1972. So essentially, when Russia bought a lot of US wheat under the radar and sort of caused the market to spike very, very quickly. And that gave birth to almost quite a lot of transparency coming particularly out of the US in terms of export reporting. And it really illustrated the importance of transparency. Since then, a lot has changed. Back in 1972, North America accounted for something like 70% of global wheat exports. Now that same region is around 30%, just under, of global exports. And so passively over that time, the world wheat stocks and now exports have lost an element of transparency because of how market shares have changed. And so there's this longer term risk that risk of price spikes. The market will struggle to keep up with the physicality of wheat supply and demand around the world. Again, not really an issue that we have to get too much focused on this season, given the availability of wheat around the world, but one of medium to long-term transparency issues that run the risk of delivering more volatility in the long run. Getting more really back to the here and now of where we are, and really to explore what global grain trade looks like. And as I've alluded to quite a lot, there's going to be quite a lot of competition out there. And this year we expect to see Russia topping out as the world's main exporter, main supplier of wheat to the world market. We're going to get into a little bit of detail about that, partly because of the scale of the Russian wheat crop, but also partly because of the demise of the European crop, really led by the issues that we see with French production. And that leads us to focus a little bit more on the Russian situation. The chart here, if we look at the first solid line there, that was the projection made in 2007 for the 10-year production trend of Russian wheat. And you can see how over time it's increased. The bars there are the actual levels of production. So you can see just the severity, the size of that Russian wheat crop in excess of 70 million tonnes, relative to where the expectation was and the reality of the previous years. The key thing really is to bear in mind that we're going to see a lot of variability, and that's where where transparency becomes quite important, because as we saw in 2010 and to an extent in 2012, the market only really learns of these things when it's too late, and so that indicates to me that there's a transparency issue and that kind of thing. And to talk about this as for the world's biggest wheat producer, we'll continue to see variability in the size of that crop is a bit of a warning light going forward. Again, I can't really call it an issue for this year given the size of the availability. For reference, that broken line there is the current projection, 10-year projection going forward, looking at how things may well change, and illustrates again just how out of kilter the size of that Russian crop is this year. There's going to be quite a lot of fierce competition, really. One of those key markets is going to be into the North African market. I've picked, or the team have picked 3 destinations there. We've left our Egypt out of there because Egypt's slightly sort of a little bit of a special case in terms of the market, in terms of requirements, although it is the world's biggest wheat importer. And really looking at performance of imports last year relative to expectations this year, and bringing it back to the French crop issue that we'll talk about shortly. And this is where there'll be a battle of the market shares into those different markets. So we expect trading patterns to change, but probably relatively little impact on flatline prices. In this case of changing market shares, you can see in the green there just how much market share France has or had in 15-16 into those markets. And for reference, you can see the influence of the UK in there as well. So there'll be a battle of the market share, and there may be some opportunity from a UK perspective as well, but it's in a backdrop of fierce supply competition as well. That brings us sort of into the French situation. I'm sure anyone in this room who went through the horrendousness that was the 2012 summer can empathise with the French wheat crop and what that means for the supply chain this year. A 30% reduction in the size of the crop, and quality issues to boot as well, not least because of the specific weight issues we see, around 40% of the crop falling below the 72 kilogram per hectolitre measure. Typically, we expect to see that less than 5%. And availability over the benchmark 76 is a bit of a key issue as well. The fundamental impact is that it has a big knock-on impact on export availability, around 1 million tonne fall in France exports into the wider EU. That might create opportunity for the UK, but we have to look into the context of there's likely to be less Spanish demand coming into the market anyway, due to good crops coming out of Spain. Anyway, the big impact from a non-European point of view is that an 8 million tonne fall in French exports to non-EU destinations, and that has implications for the whole European marketplace, which we'll sort of consider now in a little bit more detail. So this is the EU wheat supply and demand from the EU Commission, and you can see the production reality there of what we've seen in France and broader Western Europe. Caveat this is the fact that in areas like Romania and Bulgaria, there's been some uptick in production, and that's taken some of the edge off of the reductions in crops in the West. The key thing really to balance the market will be the market to regulate exports. Last couple of seasons, we're used to seeing EU wheat exports in excess of 30 million tonnes. And if we look at the EU export licences, the EU market is exporting like it's exporting a 30 million tonne wheat crop as opposed to a 25 million tonne wheat crop. I think the market's fairly relaxed about this approach, and certainly when we get to the turn of the year, if export progress isn't starting to slow by the turn of the year, then I think the market may well look to be a bit proactive and put some premium into the market to try and regulate that. The ultimate impact is that we're going to start to see sensitivity coming into European wheat stocks, and that opens up sort of a longer term dynamic, or into sort of the 2017 crop year. That removal of a stock comfort blanket makes the European market a little bit more sensitive to any weather rumours, weather stories, weather realities happening through the spring of 2017. Just while we're on the topic of European wheat market, I think it's important just to be aware of the changing structure going on in the futures markets. We're very used to the Euronext or the Paris wheat futures being the benchmark value. I think what we've seen over the last month is the arrival of the new CME wheat contract, which is putting a defined specification around that from 2016 crop, and that's creating a little bit of interest in the structure of the market, and it's having to put a bit of transparency in as well. Fast forward to 2017, we start to see also the established Euronext contract also brings some detailed specifications into the mix. Not going to get into the detail. This is important just to be aware of either if you're using these mechanisms directly as a risk management tool, or indeed if you're using them to feed a formula pricing mechanism on flour, for instance, just to be aware that there are some subtle changes afoot in some of these pricing mechanisms, and just giving it more of a defined specification behind them. I'll leave you with the global wheat conclusions to take away in your own time, and we'll start to move on to the outlook in the maize market. And really to carry on where we finished up, or where we started from wheat, you can see the dynamics here. Again, the global demand continues to creep higher and higher, as we're very much used to, but just look at the performance of some of those key exporters really driving production, notably in South America. The US continuing to drive performance, and now indeed we're looking at increasingly Black Sea influence on maize, the world's most dominant, most important feed grain, which is going to continue to have an influence on prices, particularly in the UK, going forward. The next chart just reflects that in terms of price, and apologies, this is slightly different to the chart you have in your packs. A more updated version just looks at the autumn, winter 2016 futures prices in dollars per tonne. You can just see since the middle of the year, you can see how the US prices sort of hollowed out underneath the European market. The European market's really wanting to weigh up just how much availability there is. There's almost a slight transatlantic differential between what's going on in terms of that maize availability, and so it's giving a little bit of disparity in the pricing level. So keen to just keep an eye on that, and particularly how harvest pressure materialises. The headline driver of that move lower in that global maize price there is really this, and all you have to pay attention to here is the black markers on this global supply and demand analysis. So essentially now 2 years or 3 years of relatively stable maize stocks to use ratio, 22%. Relate that back to where we were just 4 years ago when we were struggling at 14-15%, really on the back of a poor US maize crop. And you can just start to see why the market has got this growing confidence about feed grain supply in the short, and you could even argue into the medium term as well. A lot of the issue is driven by the US, that very dominant force, and the bars there look at US maize production, expected to be a very big crop. We may well see some tweaks to that from the USDA data out tonight, but fundamentally still expected to be a fairly big crop, and the influence on stocks is quite clear. And again, look at that stocks to use ratio, those black markers on that graph, more than doubled since the back end of that 12-13 season, around 20%, really again enabling those US prices to move lower. Ethanol, of course, is the topical area of the US maize supply and demand. We've become used to it in recent years becoming a very mature market, as you see in those usage numbers on that black line. We may well see ethanol demand ticking up, but ethanol demand, we shouldn't confuse ethanol production with maize demand for ethanol use, because we see increasing efficiency of turning maize into ethanol in certain US plants, but then also usage of other commodities such as sorghum to produce ethanol. And so maize isn't the only raw material producing ethanol, and producers are getting a little bit more efficient. One element really to focus on in terms of the US is just to keep an eye on the export progress. If we take the data at the end of September, the US had committed just over 20 million tonnes of maize for export. That represents around 37% of the total season forecast. Bring that back, or compare that to last season where it was just 27% at the same point. You can see the US is actually making some real progress in its export campaign, and that needs to be closely watched. Largely driven by the poor harvest out of Brazil that we saw earlier in 2016, and even Brazil itself taking ownership of some US corn, and so that's an important dynamic, and that may well have implications at the margin of the overall US wheat supply and demand, maize supply and demand. Sorry. We're going to move in to talk about the Black Sea. I'll put this slide into your packs just to give you sort of the context of the production views. there's quite a lot of clarity, quite a lot of consistency in what the various forecasters think in terms of Black Sea maize production, so I'm not going to spend too much time to that. I'd like to bring us back to Russia and think about how Russia is developing as a grain powerhouse, if you will. We talk about wheat and we talk about those big crops of that big crop of Russian wheat, and Russia has to back that off primarily through exports. From a maize point of view, we're seeing, although the numbers are somewhat lower at the moment than we see for wheat, the production is backed off by a combination of exports, with probably the European market to an extent in mind, but then of course domestic demand as well. And this is Russia developing its industry, striving for self-sufficiency on the livestock products. And one of the catalysts for speeding that up is the ban that it has in place on EU food imports. So Russia is striving for that element. So we're very much used to hearing about Russia in the wheat market. We'll continue to hear about Russia's influence on the feed grain market as well. So at various stages, there's much growing Russian influence on the grain market. From a South American point of view, it's quite uncertain times. The crop's only just being planted, may not even be planted yet in some parts. The dip in the black line illustrates the issues that we saw in 15-16, particularly with the Brazilian crop, and I think that's important. That sets up a relative tightness in the South American availabilities, and probably goes a long way to explain why we're seeing such export pace accumulating out of the US. Brazil is quite important in that, in the chart here, just looks at the production history. The blue bars are what's called the first maize crop. That used to be the dominant crop. The yellow bar there is the safrina, second crop. Corn comes after the early harvest of soybeans, and it's become much more dominant. It's actually a much more risky crop to grow from a weather perspective, and it's very much more unpredictable, and so it creates two things. It forces the world to wait longer in the season for the Brazilian maize crop to arrive, and it creates greater risk because of the greater uncertainties of weather and its impact on that crop. The expectation is that for 16-17 that we'll see a rebound in production, but it has to come with those big weather caveats in that crop won't be, that second crop, that yellow bar crop, won't be planted until really February and won't be coming into harvest until May, June next year. So we're looking at crops that haven't even been put in the ground yet to have an influence on pricing in the second half of this marketing year. Let's focus on the EU very quickly as well. And the EU is in a very relatively tight situation when it comes to maize, which will be to the benefit of broader feed grain demand for other grains. Last year, the get out of jail free card was accumulation of stocks from 2014, from a very big maize crop in France in 2014. And the market really wants to get its head around just how big that French maize crop is this year. To what extent has it suffered as the wheat crop has as well. So it's expected to be relatively tight, and likely to try and shed some demand into other feed grain commodities such as wheat and barley. I think what's interesting is that we're on the brink of seeing the maize import tariffs coming back into force based on the current formula. So if the global price moves any lower, we'll see, based on the current regime, we will see maize import tariffs into the EU coming back into force, notwithstanding the fact that we have a growing amount of tariff-free quota being offered to Ukraine as well as a solidarity measure. There are your global maize conclusions in the pack. We'll crack on and sprint through the barley very quickly. The barley situation remains pretty samey actually, and it's in two minds about how much time we spend on talking about global barley. On the surface, yes, it looks relatively tight, but we know that barley, to maintain that bulk level of demand, which is feed, it has to maintain in step with the broader commodities, and so it's really a follower of those elements. In terms of global barley trade, we were getting a little bit concerned earlier in the year because of the change in Chinese policy, which was more focused at reducing maize inventories and lowering prices, thus removing the incentive to import alternative feed grains such as barley and sorghum into China. You can see on the chart on the right-hand side just how expectations of Chinese barley and sorghum imports have fallen away. This season, that's been netted off really from a European point of view by less of a requirement to export barley, and that's where we'll sort of go next, is just to consider what that means. But before we go there, we'll look at sort of the broader barley market, and in line with lower expectations for Chinese imports, there's also lower expectations for Saudi imports as well. So two big buyers sort of likely to reduce back what they're going to take from the global barley market. And it's all about diversity then. It's all about the key to balancing out barley will be to diversify across some of those other Middle East, North African markets to take up some of the slack if possible. From an EU point of view, it's a very similar situation to wheat in terms of its sense. We're starting to see some sensitivity coming back into EU barley stocks come the end of the season. Not so much driven by lower production, but more by higher demand. Feed barley should take a bit more of a market share in Europe. From an export point of view, progress is probably in line where sort of the supply and demand balance is expected to be. The market may start to get concerned if that slows too much, if there isn't enough barley trade going forward. So it's going to have to keep an eye on that one as well. Some global barley conclusions again for you to take away. That brings us in to talk about really some of the exciting stuff happening in the UK, and I kind of it is quite an interesting time for the UK from a market point of view, from a political point of view, from a Brexit point of view. We use the term interesting times. You go to a farmer meeting and someone will say, well, it's interesting times. It's often you'll think, well, it's overused. I think the term interesting times can never be overused in the limelight of what we're facing as an industry, what we're facing as a market almost. And some of what I would call market infrastructure or the market furniture that we've been very much used to over the last 40 years is now actually up for debate, is up for questioning. So it's an interesting time, no doubt. From a UK wheat supply and demand, it also looks quite interesting because it's going to start looking and feeling very, very different in 16, 17 as opposed to what it was looking like in the previous 2 years. 14 and 15 were about two very big wheat crops driven by yield and really driven by feed wheat and creating a big carry in the market, incentivising long-term storage. Availability this year is lower, and indeed quality is shifted to become that much better. And so particularly for anyone trading feed wheat or has a feed wheat bias in their market or in their trading, there's a bit of a double whammy. Availability is lower and the quality boundary is moved as well. So from a purely feed wheat point of view, it will probably feel tighter than the actual general balance sheet would be depicting for the total wheat level. From a demand point of view, expanding poultry industry, the fact that flour millers are going to have to use more wheat to produce the same amount of flour is going to be supportive of demand as well, and there's an element of ethanol demand coming through as well, and the expanding poultry side as well. What that means, and the crux of it, what it means is highlighted in this final slide, looking at the availability for export, that much lower availability for export, so the market is going to have a key job in balancing and regulating itself and not going all out to try and export as much feed wheat as possible. So there's a careful regulation of the export progress. You would have seen in the July-August export stats a quite rapid start to the season, primarily driven to my mind by old crop stocks, and a lot of business probably done in the pre-harvest period. Take a few months for us to see the full export pattern relating to the actual crop of 2016. From a quality point of view, I think we can be cautiously optimistic. And the chart here has been just slightly updated from what you see in your packs. Last year, if you see on that left-hand Venn diagram in the middle, 31% of samples 31% of Group 1 samples made the full spec. The big limiting factor last year was protein content. If we go onto the right-hand side, we say that that's currently based at 46. There are some fairly notable caveats that have to go around this as well. Protein content is higher, but then it's the functionality of that protein which is important, qualitative element of the quality which is important to the efficiency of the end product. And I think also the key thing to remember is just to look at that specific weight as well. They've fallen off quite quickly as further samples have come in and how the harvest has progressed. And there's a lot of variability in there as well. That will be hitting the efficiency of flour extraction and flour yield, essentially. So yes, it's better, but we just have to be aware of those caveats that sit behind it as well. There's a lot of variability behind the averages that we should be aware of as well. The same for the medium quality, and what's interesting about the market, the milling wheat side of things, the quality wheat side of things, as much as it's about the pass rates, it's about how the UK wheat area has evolved between the different varieties. Anyone who follows the stuff will know that I'm a big advocate of rebalancing the wheat market to give the UK more marketable wheat. I think that's really, really important. And we can see that sort of happening. Now we've seen the likes of Skyfall and Lily coming through and giving more market share to the Group 1s and 2s. And so we always knew in the build-up that we were on the cusp of seeing a higher availability potentially of essentially medium spec 1 and 2 wheats. And Arthur Marshall and the team did some historical analysis looking at that, looking at historical pass rates and looking at from an area perspective. It gets a bit woolly if you try and replicate that into production, because you've got different yield ratios going on between the different varieties and big regional impacts as well. Run the analysis for the 2016 provisional results, and you see that close to 20% of the UK wheat area will be producing or has produced wheat that's suitable for medium grade bread wheat as a minimum standard. And that's kind of, I think, giving this very different look and feel to the UK wheat market. It's lost some of this feed wheat dominance that we've probably traditionally quite used to, and has given an element of quality into the mix as well. And that's why I sort of will put that strike through the feed in UK feed wheat futures, was trying to maybe understand what UK wheat futures represent this year, given the underlying specification on a minimum basis in the background as well. The next area of concern that I'm thinking of is where do we go with Group 3s now? Where do we go? The Group 1s and 2s have been very good at capturing some area that hasn't necessarily moved straight from the Group 4s into the Group 1s and 2s. It's actually squeezed the Group 3s in the middle. And that's cause for concern, because the Group 3s are home to some very important wheat. Particularly, it's a bit of a USP for the UK wheat on the export market and those soft wheats. And then hopefully we'll see some new varieties coming through to try and readdress that, but it may be an area of the industry to think about how it's going to develop longer term, to again upping the ability to improve the marketability, usability of UK wheat, both home and abroad. That brings us really to talk about barley. Barley remains, to my mind, a very topical subject in the UK. Spring barley, particularly in the eyes of the farmer, it still remains the go-to spring crop when we talk about issues such as blackgrass control and balancing rotation. As such, production remains relatively high, closer now to the 5-year average this year than we've been used to, but still historically a level that we were more akin to seeing, I think, in the late 90s when we were using intervention as the main marketplace. Demand-wise, though, it's kind of that expansion of the poultry sector and maybe barley's suitability into that, particularly given this year's quality of barley, which we'll come on to is a big issue. And we still remain on paper, a relatively large surplus of barley there. The quality will be a big stumbling block in terms of accessing some of those big export markets. And we'll look at this a little bit now. If I can just give you a bit of historical context. The bars on this chart are looking at UK barley production. The markers there are looking, I stress, at the average specific weight of barley. You can see just how much it's dropped off year on year and relative to history. In terms of feed barley exports, of course, price is important, competitiveness, quality, i.e. specific weight is a big driver as well. And that could be a bit of a hampering thing in terms of export progress of the barley campaign. Puts a question mark, okay, well, how do we balance UK supply and demand? Will it be left down to fed on farm, for instance, to take the heat out of it? Brings on to oats. We don't yet have new season oat supply and demand. Production number is out tomorrow from DEFRA, but certainly we're expecting, I'd be expecting a slightly smaller oat crop going forward and a tightening of the market. But this is where we can start to think long term. We think of oats and we think of the tariff structure that we have in the EU. It becomes very much a EU-focused affair. Depending on the type of Brexit we experience, in a few years' time, it may well be that we have to look at the global oat market, something we've never had to consider before, certainly in recent history. And that there may well be enough opportunity to decommoditise elements. We look at the processed products, look at the role that essentially rolled and flaked oats plays as part of our export and processing campaign. So there may well be a need to do some quite intensive market development on on that side, to keep up with the pace of change. On the theme of Brexit, I've put together what I think are my top thoughts. I don't really want to stand on David's toes here to the big issues of Brexit for the industry, but really from a series of analyses point of view, there are some key questions over what we have regarded historically as key bits of furniture in the market mechanisms in the market that we know, and we're kind of going to be questioning those bits of furniture going forward as an industry, which is unprecedented, isn't it? Really, it's something that we can't. We're in a bit of a honeymoon period at the moment from a supply side, from a Brexit point of view on the currency. That can't last forever, and so these bigger issues are going to have to come to the fore at some point. One of those issues is the theme of grain import tariffs in the EU. We currently are subject to those. They don't isolate Europe from, and indeed the UK from, the global market. We have surpluses of wheat and barley typically that we have to export onto outside of the EU, and so that means we have to compete at global prices. This is mainly looking at the import price and the management of imports, which is currently subject to these tariffs. So all you needed to know initially on import tariffs on one slide there, one caveat being on the bottom right hand corner, you've got the Ukrainian specific TRQs, or tariff-free access. Those quotas over the next few years will continue to increase, a bit of a solidarity measure from the EU to Ukraine in wake of the annexation of Crimea, and that will start to give Ukraine more of an influence on the EU market at the margin, but something you're probably going to hear a lot more about in the next few months for sure. I'll leave with my UK conclusions to take away and read, and the broader conclusions as well. Bring a bit of a theme of the Brexit and the current markets as well. But in the interest of time, I think it's time to finish. Thank you very much.
Thank you, Jack. And if anything sort of grabs your attention, it's that last slide on import tariffs. We have time for some questions. If you raise your hand, we have a roving mic wandering around. If you just give your name and your question, Jack will answer them. Whilst we're just waiting to find somebody, Jack, I heard recently that India was dropping its import tariffs. Is there any particular reason for that?
Yes, I think it's primarily driven that India is going to be reliant more on imported wheat now, principally on Australian wheat, and already in a deficit situation. I think it's just reflecting the fact that the increased reliance on imports.
Have we any questions, or are you all stunned into submission? Well, I can't see any questions. If there is anything that comes to mind, the speakers will be around. Grab them at coffee time or grab them at the lunch break. Thank you very much.